Good morning, everyone, and thank you for joining us for today's professional education event entitled Grow Your Net Worth, Top Strategies for Retirement and Post-Career Planning. This one-hour session is being hosted by CBM and MBI, the firm's financial advisory subsidiary, and our presenters today are Judy Barnhard, Aleksandr Seleznev, and Jordan Egert. To start off, I'll briefly introduce our speakers and then go over a few brief housekeeping items. Judy Barnhard is a partner at CBM and the director of the firm's wealth management, financial planning, and professional services groups. She is also a senior advisor and chief compliance officer at MBI. In her role as a CPA and certified financial planner, Judy prepares individual income tax returns and consults on retirement planning, estate planning, income tax planning, cash flow and budgeting, and risk management. She is also a regular presenter for CBM's financial planning webinars, including most recently, What is the Son of Secure legislation and how could it impact your retirement on September 2nd, and Maximizing Social Security Benefits and Avoiding Mistakes on July 22nd. Aleksandr Seleznev is a partner, senior advisor, and portfolio strategist at CBM and MBI. He is a co-founder and chief operating officer of MBI as well. Alex is a certified financial planner and a chartered financial analyst who leads the firm's investment management division. Alex's professional focus is on comprehensive financial planning and investment management. He is also a regular presenter for CBM, and in addition to today's session, he co-presented during the recent October 21st webinar entitled Top Ideas and Considerations, Long-Term Care Insurance in Your Retirement Plan, and he's scheduled to deliver the firm's market updates during our year-end tax planning seminar series in early December. Jordan Egert is a senior manager with in-depth experience in financial analysis, personal and closely held business tax matters, tax strategy planning and arbitrage development, financial consulting for collaborative, mediated, and litigated divorce cases, and forensic accounting. His work has involved accounting and financial planning analysis for support and property division matters in divorce, including cash flows, lifestyle and budget preparation and examination, retirement projections, tax projections, and asset and liability division, including their tax ramifications. Jordan has been a regular presenter in CBM's financial planning presentation series and last presented during our September 21st webinar entitled Grow Your Net Worth, Top Strategies and Opportunities for Mid-Career Professionals. Jordan will speak today about tax planning opportunities, estate planning, and other retirement considerations. The learning objectives for today's session are on the screen at the moment. There we go. Thank you, Alex. Questions submitted during registration have been submitted to our presenters, but if you do have any questions during the webinar, please use the chat box. This session is being recorded and a copy of the slides will be distributed to all participating attendees. Attendees are not required to participate in the continuing professional education portion of today's program. However, if you would like to earn CPE, you must respond to at least 3 or 4 polls launched randomly during the webinar. I'm going to launch a poll right now, a sample poll. You do not need to respond to this. The poll will appear on the meeting screen or in the chat box, so please be mindful of where the polls will appear. You only need to respond to the polls in one location, either on the screen or in the chat box. Please note it is your responsibility to identify the location of each poll. A CPE certificate will be issued to qualifying participants within 1 week. And finally, CBM launched a survey last week asking registrants why they chose to participate in today's session. I'll provide a link to the survey in the chat box in a moment, along with my email address in case you have any questions. Your response is not required, but it can help us develop future programming that will reflect your interests. And now I'm going to turn it over to Judy, Alex, and Jordan.
Good morning, everybody. I'm Judy Barnhard. Thanks for attending. This is one of our favorite webinars that we put on, along with the Social Security one. In part because it helps people think about retirement and whether or not that picture in your mind is lying in a hammock between palm trees or something else. It's exciting. It's also kind of scary, but we hope that by listening today, we can help you address, you know, are you prepared for retirement? What are the risks? What you should be doing now to make sure that you are in fact prepared. So we're going to be discussing how to create a retirement plan and financial security concerns, portfolio protection mechanisms, We're going to talk about the importance of market volatility to cash flow. I'm going to be covering cash flow, debt management, and how to prepare a budget for retirement, and addressing the longevity risk in retirement. And Jordan's going to be following up with estate planning, tax efficient wealth transfers, and tax considerations in retirement. So we look forward to covering this information, and our goal is to help you be as best prepared as possible for this next chapter in your life.
Well, thank you, Judy, and thank you everyone again for joining us today. So we'll start with your overall retirement, or with your overall financial plan in the context, of course, of your financial security. So I will start by saying that at this stage in life, perhaps you're considering retirement, perhaps you're already have a date in mind or not, or perhaps you're already in retirement. We do believe that it's very important for you to have a plan in place. Now, it can be simple. It can essentially fit on a single sheet of paper. Usually it's more complex than that. And again, we'll cover different parts of that financial plan, but really everyone should have it. Now, how secure is it? Well, the answer to that question, at least the overreaching answer to that question, really depends on how clear of an understanding you have of your income and expenses in retirement. There are many popular rules of thumb that we actually use some of them for discussion purposes, but for planning purposes, especially for long-term planning purposes, they may not be appropriate, and in many cases they can actually be dangerous. So here's some of them. Here's the 4% distribution rate rule, and essentially the way it works, let's say you're 65 years old, let's say you have $1 million portfolio, and you're trying to figure out how much you can safely distribute to yourself. So you'd use the 4% rule. Essentially, it would give you $40,000 a year. You would then, adjust it for inflation each year, which is, of course, quite high at this point. And the idea behind it is that you would not run out of money for the next 30 years, essentially to age 95. It's actually a very well documented rule. Now, there's some issues with it. I will mention a couple. One of them is the fact that it doesn't adjust for your tax situation. And of course, the impact would be different if you're drawing from your taxable portfolio versus your tax deferred portfolio. And also in times of market volatility, essentially, especially significant market volatility like what we experienced last March, not everyone is comfortable with just distributing 4% or any other percentage out of his or her portfolio. Now, the other one is when you take 100, you subtract your age, let's say you're 60 years old, and then the difference is supposed to be your allocation to stocks or equities. Now, every time we present, and I mentioned this rule, I usually check on that. There's really no basis behind it. It's a popular rule of thumb, and every so often our clients want us to comment on it, but there's no research behind it. It doesn't take into consideration your risk tolerance, doesn't take into consideration your cash needs, doesn't take into consideration where you are in life. And we actually find it to be somewhat dangerous to use, especially again when interest rates are this low and inflation is this high. There are plenty of online or do-it-yourself calculators. I would say the most popular ones are inside of your 401k or 403b plans. I'll tell you, some of them can be quite useful if you understand how those model works, meaning you understand what assumptions they're making. I will also tell you that some of them that I've seen, they're way too basic. And at best, they would give you some kind of ballpark of what you should expect. So what's a better way of doing it? Well, a better way of doing it is to run a retirement projection for yourself, or projections that consider all sources of your income in retirement, or perhaps pre-retirement, that consider your expenses, of course, and very important, that consider your tax situation in retirement. There are two main ways of doing it. There's the top-down approach. That's essentially when you start with everything you have, your portfolio, your pension, your Social Security, anything else you have. Then you would make some assumptions in terms of your projected rate of return, which is important, in terms of your projected rate of inflation, with the goal of figuring out, say, how much you would have from 65, let's say, to age 95. Again, you need to make those assumptions. Once you have that figure, you would compare it to your current expenses or your projected expenses, and you'll start from there. A different way is the so-called bottom-up approach. That's when you have a target in mind. Let's say you want to have $10,000 when you retire, and then you work toward that number, meaning how much more do you need to save over the next 5, 10 years to accomplish that goal. The top-down approach is perfect for retirement assessment purposes, meaning how well you're prepared, and the bottom-up approach is great for planning purposes, especially when we have more time. Now, here's the very important part. Once you have a comfortable scenario, you discussed it, you understand it, you're comfortable with it, it is imperative that you stress test your own assumptions, meaning what would a worst-case scenario look like? What happens if you retire and the market is down by 30% in 17 calendar days? And this is not a hypothetical. This is exactly what happened to actually several of our clients last year. They retired in the beginning of the year. Next thing you know, the markets are down by more than 30% by the end of March. You need to be prepared for that. You need to have a plan in place, and you need to be proactive about it. It's very important that you stress test your own assumptions. Now, once you have a plan in place, again, a comfortable plan, usually the next step is to ensure that your overall investment mix or your portfolio, your investment strategy matches your retirement plan or your financial plan. Now, what are some of the key ideas here? Well, your long-term performance results, up to 90% of your long-term performance results can be explained by the overall asset allocation that you have, essentially the split between your stocks and bonds. Some other ideas here is, of course, on diversification. And I would like to assume that everyone is familiar with the idea that you would not want to keep all of your eggs in one basket, but are you truly diversified? There's a great example. A few weeks ago, we had a client had multiple accounts and multiple brokerage firms. So we consolidated it for him. We showed it to him as one report. And what we discovered is that most of those funds are essentially invested in the same types of securities. So yes, he had like 15 different funds, but they're covering more or less the same asset class. So it was not a truly diversified portfolio. The idea of considering your risk appetite or your risk tolerance in the context of your longevity. And that's important. Here's an example of that. Let's say we have a client who wants to invest very conservatively, but also expects to live to age 95 or maybe 100. Let's say there's a history of longevity in this person's family. What are the chances that this person would actually run out of money by the time he or she reaches, 85th or maybe 90th birthday? We need to assess for that. Of course, your age, meaning your age of retirement, if you're retiring at 60, 70, or 75, would have quite a bit of impact. And your inheritance considerations, meaning if you're expecting to receive some and there's a good certainty, then chances are you need to include it in your plan, or if you want to leave a certain amount to the next generation. And I'll tell you with that, especially with some of our clients already in retirement, every so often would have that conversation. Look, you seem to be doing pretty well. So who are you actually investing for? Are you investing for yourself, or is this really for the next generation? And again, that would have perhaps some impact on your investment strategy. There are other factors, of course, and what we discovered and what we'll talk about in a moment is that the so-called cash flow based approach, when again you look at your personal circumstances, is the best way, the most objective way to determine what your investment mix needs to be. And I'll give you an example in a moment. Now, in terms of the portfolio protection mechanisms, so what you're looking at here, these are the three models, relatively common models. You have a conservative mix that consists of 20% stocks and 80% bonds and short-term investments. You have a balanced mix, which is essentially a 50-50 split, and you have a growth allocation of 70% stocks and 30% bonds. I would say as expected, the growth allocation outperformed the other two over the past almost 100 years at this point. But I really wanted to focus more on the conservative mix here. So notice that it returned close to 6% again over the past 100 years or so. Now that's great, but given how low interest rates have been, and even though they're expected to go up once or twice next year, they're still expected to stay low, and our current level of inflation of more than 5%. Would it be realistic for us to assume that in the long run, a conservative portfolio like this would actually earn 6%? Again, back to the idea of not outliving your money. So we have to be very careful when we make those assumptions. Now, this particular graph is actually one of my favorite ones to discuss, and we update it usually at least quarterly. So this is the asset class returns quilt, and what it shows you the performance of each major asset class year by year from 2011 all the way to year to date. And then on the right side, we essentially summarize it for you, summarize the performance of each asset class. There are two important ideas I wanted to point out. In terms of, again, your diversification, notice how differently each asset class performs each year. Look at 2020, the bottom of the 2020 column. Notice that commodities and real estate stocks were the worst performers last year, and I would say for legitimate reasons. Notice that year to date, they're actually the best performing asset classes. Again, commodities and real estate. Domestic large cap, mid cap, and small cap stocks performed quite nicely last year, and they continue to perform well this year. International developed stocks performing more or less the same at this point. Cash is, of course, not earning much, essentially not earning anything. And the second point I wanted to make, notice that bonds, or the domestic fixed income, is actually in the negative next year. So again, when we're projecting, when we're designing our retirement plans or investment strategies, what are we assuming? That in the long run, bonds would return closer to 3 or 4%, or perhaps lower than that. Again, we have to take into consideration our current market conditions and truly diversify our portfolios. Now, in terms of the cash flow based approach, here's a, I would say, simplified, but this is a realistic example, so you see how we would actually do this. Again, the goal here is to determine objectively what this client's asset allocation needs to be. So her portfolio value is at $800,000, and we determined that in order for her to maintain her lifestyle, she needs $7,000 in retirement. Now, she's a former government employee. She has a pension. She also has her Social Security income, $3,000 net of taxes. So we really need to replace $4,000 for her. So we need to simulate a paycheck out of her portfolio of $4,000 per month for life. Now, once we determine that, our next step is to annualize it, essentially multiply it by 12. We'll then multiply it by 7, and I'll talk about why in just a moment, which gives us $336,000, which is how much we would want her to have in bonds, cash, or other liquid investments. Now, what is so special about 7 years? That happens to be the average business cycle in the United States, meaning if/when there is a recession, on average, we'll expect the markets to recover over 7 years. During that period, we want our client to be fully protected from the market risk, or from the stock market risk to be specific, meaning we want her to have enough bonds in her buffer to again supplement for her cash needs. Next step is to take $336,000 divided by her portfolio value, $800,000. That gives us 42%, which would be our suggested allocation to bonds. Of course, from there, we would have a conversation, see if our client has any specific preferences, right? And of course, we would adjust for the market conditions. So perhaps at this point, we'd prefer to have less in bonds compared to, let's say, stocks, specifically dividend-paying stocks. So the bottom line here, we do believe that this is the most objective way of determining what someone's asset allocation should be. And again, the idea here is to isolate someone's portfolio cash needs for the next 7 years, or for one full business cycle. So in summary,
Alex, let me just interrupt you for a quick second. I'm launching the first poll. Please take a second to respond to the poll either in the meeting screen or in the chat box. I'll keep it open for another 10 seconds.
Right. Thank you, Joe. So just to sum it up, again, at this stage in life, we strongly believe that everyone should have a plan in place. It can be simple, or in many cases would be more complex. Once you design it for yourself and once you're comfortable, make sure that you stress test your own assumptions. Again, what would a worst case scenario look like? Your asset allocation or your investment mix is the most important factor in terms of your long-term performance results. And we suggest that you consider using the cash flow based approach that I discussed earlier, again, for planning purposes. And then very important, stay disciplined and do not panic. Again, it is normal for markets to correct. Correction is when the markets are down by 10% or more. And every so often, yes, we do expect to have a recession. But again, if you have a plan in place and you're preparing for those types of events, it should really help you. Now, like with any other plan, it's a dynamic process. We recommend that you review it at least annually. And if things are changing in terms of the markets, in terms of your situation, then would normally recommend that you do it semi-annually. And with that, Judy, what do you have for us?
Thanks, Alex. I'm going to be discussing debt management and how to prepare a budget during this next section. Next slide, please. Okay, in preparing for this webinar, I did a little bit of background check about how many retirees actually enter into retirement with debt. And according to a Forbes article that I read, 61% of households that are headed by someone 65 or older have debt. And that's, pretty shocking, really. And Experian, which is one of the credit bureau agencies, they actually have a report that shows that the average personal debt, not mortgage debt, but personal debt of those age 70 years old is $20,000. Now, that could be an automobile, and one could understand that. But what's of most concern is retirees basically having what I would call, high interest debt that they're carrying into retirement, be it from credit cards, and maybe you've read recently that a lot of people are taking on student loans for their adult children because of the cost of higher education now. And so, credit card debt can carry interest rates of, 19%. Some of the student loans are carrying interest rates of 8%. And so right off the bat, if you are contemplating, retiring and you are carrying that kind of debt, I definitely would caution you to, take a step back and address how to pay off that debt before you really start retirement. Just good, prudent, financial advice that you don't want to be carrying, a monkey on your back going into retirement, and specifically high interest bearing debt. Now, separately with regard to mortgage debt, take a little bit of a different tact here. For someone that's age 45, for example, and enters into a 30-year loan, mortgage loan, let's just say $450,000 at 3%, and they retire at age 67, well, if they took it out at 45, they still have a mortgage left even when they retire. And they're going to be at the latter half, which means they're going to be paying more principal than they are interest. And so the question is, well, should they pay it off or should they go ahead and carry the mortgage debt into retirement? This is kind of an interesting example because in this case, it actually is almost the same as to whether or not they paid off the balance before they retired or they're making the monthly payments till age 75. Now, of course, there's a zillion different assumptions here. One is obviously the amount of the mortgage, the interest rate on the mortgage, how many years left that the retiree has to pay on the mortgage, what the interest, the growth rate on their portfolio is. In this case, we're assuming 8% and a 3% inflation rate. So all those are factors into this, plus the income tax consequences. So here we assumed that the retiree is going to take the standard deduction because the amount of the interest is low when you're in the latter half of the amortization on your mortgage. But you do have to take into account whether or not you are itemizing and you are in fact getting a tax benefit of deducting that mortgage interest. And in addition, where is the money coming from to make the mortgage payment? So if you're taking it out of an IRA account that's being taxed at the higher ordinary income tax rates, well, that's counterproductive. And so that needs to be taken into account as well. So just in summary here with regard to debt, pay off the high interest consumer debt. If you can, try not to get into the student loan debt situation, or if you do, have plans to work longer so that you can help your adult children get their student debt paid off. But that is, if you take it out as a Parent Plus loan, that is your debt and you're responsible for it, and it does carry a higher interest rate. So best to have all that taken care of before you actually retire. Next slide, please. Here's an example of whether or not you should have a 30-year mortgage or a 15-year mortgage. And I just want to say that you can enter into a 30-year mortgage, which gives you the flexibility, obviously, of doubling up a payment should you want to. So if you wanted to essentially have a 30-year mortgage that amortized over 15 years, you just go ahead and pay the next month's principal, and you will effectively achieve a 15-year amortization. So what is that doing for you? Well, in this case, the monthly payment is higher in a 15-year mortgage. It's higher by about $1,300. But look at what you're saving. Saving, $223,000 in interest over the course of that mortgage. So, I think the 15-year mortgage is, if you can afford to do it, is very popular if you want to be debt-free by the time, you retire. And if you can't afford the 15-year mortgage, or the fact that you have a fixed monthly payment that's higher, consider the 30-year, but doubling up on your mortgage payment so you can reduce that amortization schedule. Next slide, please. Okay, so now we're going to talk about constructing a budget, which is really step one in deciding whether or not you are in a situation to retire. How do your spending habits change in retirement? This is a NerdWallet source based on 2020 spending. And you'll see the single highest cost here is housing. 35% is basically deemed to be of your budget. So that would be the first thing to talk about. Do you want to consider downsizing, especially with housing prices so high right now? You might be at a great situation where you can sell your house and downsize. And you also might consider, moving to a lower cost state. So if there's anything that you can do to control your expenses besides the debt that we talked about, is the housing. That's going to be your biggest nut to crack in terms of reducing your overall budget while you're in retirement. Next slide, please. So this is something that we found that Smart Asset came up with. It talks about how your spending habits are likely to change when you're in retirement. It kind of coincides with the basic rule of thumb that you can expect expenses to be roughly 70 to 80% of your pre-retirement expenses. So where are you going to be having the greatest savings? Well, you're not going to be spending money on education, insurance, pensions, tobacco products. I don't know about that one. Transportation costs are expected to be lower. Alcohol, food, entertainment, all these costs are expected to be lower. Charitable giving is expected to be higher, but of course that's discretionary. Healthcare, that's a biggie, and we're going to talk about that more in a minute, but that you can expect to be about 44% higher according to this chart. And reading, although I guess if you went to the library, I'm not so sure that that's the case. This just gives you an idea of what maybe to consider as you're constructing your budget. Next slide, please. Okay, this is the starting point. Whether or not you use Quicken in your household or you want to throw this in an Excel schedule, go down and itemize monthly what your current expenses are, and try to be really honest with yourself when you're creating this. It's kind of human nature to think, oh, I don't spend $1,200 a month on food. Oh, I'm not going to spend, $450 a month on clothing. But if you really want to be successful in retirement, you have to be honest with what your current expenditures are. And, go back and look over a look back period, 1 month, 3 months, 6 months, or for the year, preferably, and get a good handle on what you're actually spending money on right now. And that's going to be your first column. And then you can make adjustments and say, okay, well, maybe when I'm in retirement, rather than spending $2,000 a month on housing, I'm going to spend $800 on housing. And you make those adjustments through this column. You'll see some of them may go up. Medical is going to go up in this particular individual's forecast. They're going to say they're going to spend more on medical expenses, but more on gifts, more on maybe personal care, but less in all of the other categories. And so then you have a budget that you're in retirement, you're going to be spending $6,000 a month. You take that times 12, that means you're going to be spending $72,000 a year. Okay, so that's a good starting point. Then you have to decide, well, what are my fixed sources of income? And that would be Social Security. For many people in the Washington, D.C. area, that would be their FERS pension. And for other that have worked with corporate companies, they might also have a pension, a defined benefit plan, that's giving them a fixed amount that they can feel as a secure source of cash to help offset that $72,000. So that means you subtract that, you have $50,000 a year that you would need to have generated from your savings, your portfolio essentially. And if you currently have a portfolio of $1 million, that would mean you'd have an annual distribution rate of 5%. That's where you start thinking, okay, is that achievable? Now, what Alex was just showing is that one rule of common rule of thumb is a 4% distribution rate is fine. Is 5% okay? Well, it depends. Again, are you taking this out of a brokerage account that's going to have lower taxes, or are you going to be taking it out of primarily retirement account that's going to be taxed at a higher amount? So it has to be taken into consideration as to the source of the actual portfolio funds itself. And something else that this particular budget doesn't take into place is the income taxes, and that's because everybody's tax situation is different in retirement. But obviously you have to consider the income taxes associated with it. Next slide, please.
Okay, Judy, I'm going to just quickly interject here to announce that I'm launching the second poll. Please look either on your meeting screen or in the chat box. I'm going to leave this poll open a little bit longer to give people a chance to scroll to the bottom of their chat box and respond to the survey.
Okay, thanks, Joe. Healthcare costs. So the cost of healthcare for a 65-year-old American couple, so we're talking about two individuals retiring this year, has now risen to $300,000 in 2021. And for those of you that are interested, that's a jump of 88% from $160,000 in 2002. This is according to Fidelity Retiree Healthcare Cost Estimate. So $300,000, well, what does that represent? It represents your Medicare Part B and Part D premiums, so that's about 39%. And let's just talk about that for a second. Those premiums are based on your adjusted gross income that you file on your tax return for 2 years prior. So there's always a catch up. So part of effective tax planning, which Jordan will be going over, is you want to try to keep your adjusted gross income lower so that your Medicare Part B and Part D premiums will be lower in 2 years. And every year, those premiums are going to change based on the tax return that you filed 2 years prior. 42% of healthcare costs are going to just represent co-payments, co-insurance, deductibles, and then the final 19% would be from your prescription drugs. So you have to take into account that in your retirement, your healthcare costs are going to go up. They're going to go up and continue to increase, probably at a higher rate than regular inflation. And be sure to add an appropriate adjustment in your retirement budget to take into account these costs. Lastly, as it's put in blue there, the number does not include long-term care costs, which is the subject of our next slide. So hopefully you have long-term care insurance. Those of you that don't, this is a pretty sobering slide. 80% of Americans turning 65 today will need some kind of long-term care. On average, women will need longer because they live longer, 3.7 years, and men approximately 2.2 years. Now, This is the cost of long-term care in Maryland in 2020 versus 2019. This information is also available by wherever you might live in Virginia or DC, or some people I know are moving their adult parents to lower cost areas. A friend of mine has her mother in Atlanta, Georgia, just to be able to save on costs. So that's something to keep in mind. But just want to highlight here, if you look at under the assisted living facility, private 1-bedroom, $60,000 in 2020. It's a 16% increase over 2019, 16% increase in 1 year. And look at the nursing home care, a semi-private room, $123,000 in 2020. And we see this with clients that we're currently managing their portfolios for, and the monthly distributions that they need just to cover nursing home. So of course, many people are moving more towards home health care. It's a great, I think it's a great change to help really lower the costs. But even home health care, if you look at this, we're talking maybe almost $60,000, $55,000 to $60,000 a year for home health care services. So if you don't have long-term care insurance and you're still within the sweet spot for buying it, Alex just did a seminar that I think is available on our website a couple of weeks ago. It's time to look into that. If you're already older, then when it probably makes sense to have long-term care insurance, then you need to factor in this into your budget in deciding if and when you're ready to retire. Next slide, please. For Social Security, we have our most popular webinar that Alex and I put on is how to strategize and maximize your Social Security benefits. And it takes a whole hour, and it is actually a lot of material that we go over. But this is one of the slides just for your consideration when you're thinking about retiring. In 2022, the maximum benefit that that a retiree can receive from Social Security ranges from $23.64 if you retire early at age 62 up to a late commencement age 70 of $4,194. So if you delayed your Social Security all the way to age 70, that's an $1,800 increase from taking the benefit at early retirement. So $1,800 a month change. So why would you basically decide between the early, mid, and full? Well, obviously, in the case of an early distribution, if you have immediate cash needs and you have limited resources and or potentially shorter life expectancy because of a chronic illness, well, then you might want to go ahead and start taking distributions at age 62. In terms of full retirement age, this is going to apply to most people. There's no penalty for earned income once you reach the full retirement age. If you have average life expectancy, you'll get the $33.45 a month, assuming you have the wages to support it. It's still a $981 increase from age 62, so quite a big bump just from waiting that from 62 to 66 or 7. And then at age 70, here you'll normally start pulling at age 70 if you have you have an existing investment portfolio and other sources of income like the FERS pension or other earned income. So you don't need to be receiving Social Security benefits. You might as well let them continue to accrue in value. And if you have an above average life expectancy, certainly having that level of increased Social Security benefits available for you for a long time would definitely help meet your budget during retirement. Next slide, please. So in summary, this individual, oh my, he's got his hands up. I can't tell you the number of people that we see in our office. It's usually women, and they are petrified. Maybe they were born during the, Great Depression, and they just saw how their parents struggled when they were younger, and they are so worried that they're going to outlive their money. So it's no joke. I mean, modern medicine's wonderful, and everybody, we are living longer, God bless. And so you have to think about that. When we construct our retirement projections, we're, by matter of fact, working it to age 95, unless the client specifically asks otherwise. We've had some asked to go into, over 100, and some have asked for a lower period if they have some, medical challenges. But plan for it. Plan, for longevity. Think about working longer if you need to basically shore up your portfolio savings so that it ensures you to have a more comfortable retirement without having the anxiety about longevity risk. Adjusting your investment strategies, as Alex went over earlier, timing of Social Security payments, exactly what we just discussed. Fixed income is huge. If you happen to be fortunate enough to have sources of fixed income that are guaranteed, it makes a big difference on when you can retire. And of course, living arrangements, whether or not you move to a low-cost state or whether or not you live with family members, downsize, all those items we talked about, because that housing costs, other than healthcare costs, are really your biggest costs of concern during your retirement.
Okay,
Next
Judy,
up
I'm going to
is George.
launch the third poll. I'm going to keep this poll open for about 10, 15 seconds. Please take time to respond now.
Okay, Jordan, I think you're up.
Jordan?
All right. Thank you, everyone. Thank you, Judy, for the excellent information. So today we will be talking a little bit about estate planning, some of the intricacies of it, mostly at a high level, just to make sure everyone's aware of what you might want to consider basically now and into the future, and also some tax efficient wealth transfers that'll tie into some tax planning and tax minimization strategies a little bit later on. So let's start with estate planning. I have a favorite saying I always speak with our clients about, and it comes from Ben Franklin: nothing certain in life besides death and taxes. And that's certainly true. There's no way to avoid them, but what we can do is effectively plan for them. So estate planning involves deciding how you want your wealth distributed in later years and or after you die, or if you become incapacitated and unable to make your financial decisions. So let's put this into perspective. I'll give you a little story about someone you may be familiar with, Prince. This is not to scare anyone, but it's just to show you what the perfect storm of not planning entails and what happens after the fact. So this is obviously a famous artist, had about $300 million in his estate, which is basically doubled now to $600 million. He had no children. His siblings predeceased him. Parents were deceased. We have a couple people that love Prince. So it was kind of the perfect storm. There was no one in a direct lineage or indirect lineage that could effectively pass on his songs and his tracks and his collection of records and rights to his music to. So what ended up happening, because there was no will, effectively his estate went into probate. And what does probate mean? Basically, DC, Maryland, Florida, California, whatever state his estate is in, decided how to split up and effectuate the division of his estate assets. So what happened from there were all the beneficiaries that Prince said, hey, I'm promising to give you X dollars, I promise to give you Y dollars, are all in cahoots. And since the estate opened, there have been over 2,700 court petitions about who is due what. And it is just going on and on and on. And now the IRS has stepped in and has to have a claim in what the value is. So it is just a train wreck of massive proportions. And I tell you this again, just to let you know that a little planning of having a will or having trust documents can avoid this whole issue. So we'll talk a little bit more about some of the estate strategies in a second. So when we talk about estate planning, that's a wide breadth of issues that we talk about. Again, it really involves, once you hit retirement, what happens to your assets now as you pass on and even after. I'll touch upon a couple items that we usually speak about with our clients. We usually recommend always having beneficiary designations updated, so in case you do pass away or you do have an issue where you become incapacitated, you can immediately have them step in, or you can immediately have them receive what's due to them. We also advise to think about setting up trust, and when you have a trust set up, you effectively bypass any probate issues and you're protected from creditors attacking any of your assets going forward. Also, having a will, we usually recommend having that immediately or as soon as possible, just so you have your directives in place of who might get what and how things should be construed with your executor. I also want to point out that we have this item, which is a letter of intent. This is a very informal document that we just suggest having in case there's a complex trust or estate issue going on. This is not something that's a legal document. It's really something that's written up just to say, we meant A, B, and C by this document. Please do not infer otherwise. And this just kind of dovetails onto your will, trust, and other estate documents to say, please effectuate it this way. We also recommend having your assets, your liabilities all listed out. Just update them, maybe every 6 months, and have a password list available as well. I had a case where I worked on with one of my clients many, many years ago, and none of their passwords were listed for their online bank accounts or any of their PIN codes to access any of their funds from their brokerage assets. And it took months and months and months before they could access anything, even with their power of attorneys. So just keep some of these things in mind, that as you go along, you may want to start effectuating some of these estate planning strategies. Okay, so taxes near and in retirement. Many of the people on here are some of our clients and some of our internal staff members as well, know that I love arbitraging tax situations. The goal is to minimize tax where possible and have a tax efficient retirement and have a strategy and plan in order to make sure that you are keeping more of your budget above the line instead of giving it away below the line. So instead of paying out each year more and more and more taxes, a little planning on the front end goes quite a ways away. So before we even delve into any of the tax issues, I want to talk a little bit about what's going on right now. And by what's going on right now, we have an issue, or not an issue, we have kind of a proposed regulation update to the tax code, and it is a doozy. We had the Secure Act, which many of you are familiar with, that was passed not too long ago. And what it did was a few things, and a few key things. It lifted the traditional IRA contribution from age 70 and a half to basically unlimited. So if you're 80 or 85, 90 and still working, God bless you. But you can still contribute to a traditional IRA at that point as long as you have earned income. You can also continue your catch-up contributions, which the proposed change, still in process. Instead of having a $1,000 catch-up contribution, we may go up to $10,000 catch-up contributions in 401ks. And IRAs would instead be indexed for inflation. So basically every year it would go up incrementally instead of right now where your IRA contribution might go up $50 every 2 or 3 years. The big important one, I think, your RMD, which is your required minimum distribution, that effectively says you must take out and withdraw X dollars, will start being increased to age 75 if these rules pass. So what that means is you have a longer amount of time to let your funds sit and simmer and grow tax deferred or tax free until age 75 when you must take them. We'll talk about QCDs in a second. Just know that the value of which you can maximize your qualified charitable distribution, we'll talk about what that is in a moment, but for those that know, will be inflation adjusted each year. Okay. So Roth conversions and Secure Act considerations. The big thing to take away too, what the Secure Act did was that it effectively said, hey, no more stretch IRAs. We gave you the benefit of that years ago, but the balances are getting so large that we can't realistically continue on with stretch IRAs. And what's a stretch IRA? That was effectively a way to give your IRA retirement assets over to a beneficiary, and then it can stretch it over the lifetime. So they could just take little bits and pieces each year instead of being mandated to empty out the retirement account by a certain period. So what ended up happening with the Secure Act recently was basically a mandate that said, if you inherit an IRA, you must empty it out in 10 years, which not the best if you have someone, for example, that is 45 years old and starting to ramp up their income, and then they have to deplete that IRA in 10 years at their highest income tax rates. So what can we do to prevent the stretch IRA rules to kind of mitigate the tax burden that it could cause for some of our beneficiaries? Well, what we could do in our retiring years, we could start thinking, well, if my income tax rate is pretty low, I might think about converting, which means taking from one pool and putting into the other. So taking from one IRA and converting it over into the other IRA, basically doing a Roth conversion. You could create tax-free income and tax-free distributions for your beneficiary once you had the inherited IRA received by the beneficiary themselves. And we won't go too far into Roth conversions, but just know it's really effective of basically taking a taxable inherited IRA and turning it into a non-taxable one.
Okay, Jordan, I'm going to launch the final poll now. I'll keep it up on the screen or in the chat box for about 15 seconds. If you need to respond to the final poll, please do so now.
Sure. And since we're coming up on time, I'll just kind of keep rolling through it. So other items we should consider and know going into retirement, there are changes in the tax brackets. There's sunset provisions, which mean that in 2025, we will revert back to 2017, 2018 levels. So right now we have an increase in taxes. Sorry about the crude laser point. And know that there's a proposal currently being discussed that will widen the gap in the tax brackets, meaning you will be taxed at a higher rate lower in your income. So for example, the 24% tax bracket will kick in at a lower income amount. So if that starts, just be prepared, our income taxes may go up. And for those in DC, I just found this out and it completely caught me off guard. It was somewhat quiet behind the scenes. DC income tax rates have now just jumped up about 3% maximum tax rate. And that basically kicked in at incomes above $400,000 to $500,000. So now the max income tax rate in DC, 10.75%. Incredible. So estate tax rates, I just want to point this out as well about what happened before the Tax Cuts and Jobs Act. We effectively started at having a gift tax exemption, meaning we could give away up to $5.5 million, which anything above that would be taxed at 40%, and anything under that would be at 0. right now, the way the tax regulations are, is that we're almost at $12 million of gifting that could be tax-free, and that's on a per person basis. Once this sunsets in 2025, we will revert back to $5.5 million, which is inflation adjusted, so it'll be closer to about $6 million on a per person basis that we could give tax-free to any of our beneficiaries or anyone we wish to gift to. I do want to point out that we mentioned earlier we may want to consider where we'd like to live in retirement. That is definitely a great thing to consider when we're thinking about budgets and when we're thinking about estate exemptions. But just keep in mind there are ongoing court cases about estate taxes and nexus issues, meaning if you had been in one state for 75 years of your life, moved to a estate tax-friendly state, there may be issues settling up your estate taxes with that state or clawbacks from the other state. This is state-by-state basis. I just wanted to point that out. So how can we minimize our taxes? I always like presenting this slide. We basically play the tax bracket game in retirement. We have what we call these gap years in retirement, which is basically lower income years before we start turning on our retirement distributions. And what we can do is effectively manage how we time our income. So as you can see here, we basically have in current tax regulations, 0% tax on our capital gains and qualified dividends rates, as long as we are under approximately $82,000 or $81,000 of income on those capital gains. So we could play around with the timing in those years and say, okay, let's take and front load capital gains now, pay zero tax on it, and then backload starting some of our distributions and things to that extent. Okay, a couple more slides here on minimizing tax, and then we'll jump into some Q&A. Tax planning strategies, this is where I think the most value from my section comes into play. We really need to start thinking about how we invest tax efficiently, and right now it's a little bit up in the air. Generally, we would recommend that you invest in a lower tax generating asset or income producing item. But with the current proposed changes in the tax reform, we don't know if there will be increased tax on capital gains or increased tax on dividends. So just keep that in mind as we start approaching to watch how the tax regulations are forming. And just know towards the end of the year, you might want to go back, revisit them, and review how they impact your investment strategy. I want to skip ahead to tax efficiencies, qualified charitable distributions, and donor advised funds. This is an excellent way if you have, as part of your estate planning mechanisms, a charitable side of your estate, meaning that you wish to donate over to certain charities. The QCD and DAFs are a mechanism for which you can supercharge your donations. And what do I mean by supercharge? If we do a qualified charitable donation, we can effectively donate our required minimum distribution to, let's call it ABC charity, up to $100,000 per year. So if we do not itemize our deductions, what ends up happening is that $100,000 required minimum distribution becomes $0 taxable just because you donated it straight from your required minimum distribution. So no benefit on an itemized deduction. You can make a benefit of it on your required minimum distribution. Works really well. The donor advised fund, just want to point out real quick, if you have a very high income year and you're about to retire, you may want to consider doing this. Basically what this means is that instead of donating along the line year by year by year by year, you are front loading your donation. So if you were to donate $1,000 per year for the next 20 years, you might donate $20,000. But what we would do instead is say, okay, let's front load this donor advised fund, put $20,000 in it now at our highest income tax year, so we get the deduction for it. And then in the fund, you direct it to then carve out little pieces over the next 20 years. So we're playing the tax bracket game where we're taking advantage of a high income tax year and taking a deduction against that instead of donating in a low income tax year where we may get no benefit for the donation. So strategies for minimizing tax, I just want to call this out for just a moment. Be very strategic when you're thinking about timing. Doing so allows us to place income in different years, allows us to take advantage of non-income tax items or income tax items at a preferential rate. And you also want to be considerate of any regulations and reform that are coming up. There is tons and tons and tons on the docket. So just keep that in mind that what's new or what's valid today could be changed tomorrow. We always recommend to run tax projections mid-year or even towards the end of the year. That way you can see if you might be over or under where you're expecting your taxable income to be, and also implement strategies before the end of the year to take advantage of some of them. The big considerations, think about how your itemized deductions will work. Think about how your credits will work. There's a lot of them that kick in lower income thresholds. Some of them are savers credits for retirement contributions in low income years, etc. Keep that at the forefront. And touching on what Judy said earlier, consider your residence in retirement. It's always a good consideration for how income taxes affect your long-term retirement plan, how the estate and gift taxes impact your plan, and see how the cost of living impacts your budget on a day-to-day or monthly basis. But with all that considered, we still need to think about how our quality of life is. So that should always be at the forefront in addition to your financial plan. The other item I just want to point out briefly before we wrap up our presentation today is there's a really excellent opportunity for those in states that have a state income tax. You can think about starting to contribute as well to a state-sponsored 529 plan. And in doing so, you may also receive a state income tax deduction up to a certain threshold. I believe in Maryland, it's $2,500 per recipient or per plan. So that basically walks out to about $500 or $600 of income tax deduction. So think about that as part of your estate planning or estate strategy as well, or even your gifting strategy. Maybe instead of gifting X dollars to a grandchild, you instead gift them components into a 529 plan and take the state tax deduction. I have tons and tons and tons more to talk about the tax minimization strategies. Please feel free to reach out. We do a presentation at the end of the year discussing ways to implement them and other key aspects and takeaways of new regulation and reform. So if you're interested, please attend that. And with that being said, we'll move on to wrapping up. We do have our CBM 100-year anniversary. We are celebrating 100 years of being in business since 1921. We're pretty proud of that. We've been going and going and growing and growing. So we offer all sorts of financial services, advisory expertise, and we're looking forward to growing for another 100 years into the future. We have some upcoming events. We'll leave these up here for everyone to review. Upcoming November, one in December, they're all tax planning and also, also financial planning based. And with that, we thank you for coming today. This is part of our CBM and MBI presentation. Our information is on the last slide here that we'll leave up for you. Please reach out with any questions you have. We're happy to respond and happy to talk shop with you.
So, thank you, Jordan. So this is, yes, the official part of the presentation is over. We do have 3 questions, actually. Judy, Jordan, would you like to address these questions now, or should we ask the participants to reach out to us separately?
No, we can address some of these questions now. Just anybody that needs to drop off, we certainly understand, and thank you for attending. I'll take one. It says, what is an HSA? That's a health savings account. So if you work for an employer that happens to have a high deductible health insurance plan, that allows you to contribute on a pre-tax basis to a health savings account. That account is portable. It kind of works like an IRA. It even can be invested, and you use it to reimburse yourself for qualified medical expenses. So it's a great way of being able to reduce your taxable income, just like you were contributing to a retirement plan.
Sounds
Exactly.
good. Here's another one, perhaps for you, Jordan. Do both spouses have to be over 65 to get the 27,800 deduction? So to get the higher standard deduction.
I'm sorry, can you repeat that, Alex? You broke up on my end.
Here's the question from one of the participants. Do both spouses have to be over age 65 to get the standard deduction of 27,800?
So if you're married filing joint and your spouse is 65 or older, basically a standard deduction increases by $1,350. And if both of you, basically both spouses, are 65 and older, it would then increase by $2,700. So it's on a per person basis that you get the bump up.
Sounds good. Here's another question.
I'll just do a follow-up on that HSA. Yes, a self-employed person can establish an HSA if they open a high deductible health insurance plan underneath their self-employment business.
And Judy, I just want to touch upon that real quick as well, because I know many of our attendees are in the retiring age, going into retirement, planning retirement, is that the HSA contribution cuts off once Medicare begins. And that's starting 6 months prior to your eligibility for Medicare. So you have a lockout period before then. So just make sure, because we've had some people continue to contribute to their health savings account, and then they have a surprise tax bill. So HSAs are completely a great tool to use for planning purposes, but just know there are restrictions there as well to be aware of.
Jordan, that is such a great point. I would say every year we have a couple of clients who have that issue. So it's very good. Well, there's one more question. What would happen if you inherit an IRA and pass away before the 10-year liquidation period? Anyone like to address this question, or would you like me to address it?
Alex, go for it.
Yeah, so this is, we got this question multiple times in the past. I've done some research on that. Based on my understanding, the successor beneficiary, which you would establish essentially when you inherit that account, would need to distribute the funds over the remaining period. So again, it's the 10-year period. Let's say you die in year 3. Your successor beneficiary will have 7 years to distribute the rest of the funds, meaning the 10-year would not renew. That is my understanding at this point.
And I think we should also point out, Alex, that there are exceptions, albeit slim ones, to the 10-year mandate. If you are a qualified individual, and there's IRS definitions, you effectively can circumvent the 10-year drawdown on the inherited IRA. And that's basically if you're a spouse, if you're incapacitated, and this is for the beneficiary, if you're chronically ill, or if you're less than 10 years apart from the person that you received it from. Again, special rules. I would recommend that you reach out to us if you'd like further information on it, but just know there are little caveats everywhere in the tax codes that allow for certain things to happen.
Great. Well, I think we pretty much covered everything.
All right. Thank you. Thank you for attending. We appreciate everybody joining in, and hope you'll join in for our year-end tax planning. We didn't cover a lot of what's going on Capitol Hill that Alex and I did, and gosh, Alex, what was it? It was the Son of Secure Act, I think, that we covered. But it's all changed, and it's changing daily. So we decided we weren't going to, again, going into something that might change by tomorrow. So, but we hope that by December, when we have our year-end tax planning update, that we will have a better idea of what the proposed legislation is for next year. All right. Thank you. Good to see everybody. Take care. Bye-bye.